am here because I believe in what I'm doing. And I basically got to the point in my career where I realized the way to have a bigger impact was to have more capital available to deploy into the things that I believe in.
GridStor is far from a household name in battery storage. The company's just a year old, and the young, fiercely competitive industry already has its share of dominant players. But GridStor started where others only dreamed. A $1 billion equity investment from Goldman Sachs made the developer, owner, and operator of battery storage projects a unicorn on day one, all while turbulent capital markets stymied the broader clean energy industry. I'm John Engel, Content Director for Renewable Energy World. And this week on Factor This, I'm joined by GridStor CEO Chris Taylor, an EDP Renewables and Google alum working to scale the next great battery storage platform. Taylor breaks down the evolving market landscape for battery storage, explains how GridStor navigates uncertainty in capital and tax equity, and describes corporate sentiment toward the fledgling industry. That's all next on Factor This from Renewable Energy World. Chris Taylor, thanks so much for joining the Factor This podcast. It's great to see you.
Thanks very much for having me, John.
Yeah, really excited to be talking about battery storage again and move this conversation forward, at least for our podcast. Listeners will appreciate that we, on episode 35 now, we had FlexGen COO or CCO Jan Brandt talking about more foundational elements of battery storage, the role of software playing in, maximizing those assets. And then more recently, we had KeyCapture CEO Jeff Bishop, who is stepping down and moving on to other opportunities, and can't wait to hear what he's up to. He joined episode 50 for a deep dive into the use cases and markets for battery storage. So if you haven't listened to those episodes already and are interested in battery storage, please go there first, because we are trying to push this forward here with Chris Taylor, and we'll link to all those episodes in the description. That brings us to today, Chris, and looking forward to exploring more of the nuances of battery storage financing and corporate procurement. That is right in your wheelhouse, and we'll get to your background here in just a bit. But just to set the stage, GridStor is a fairly new player in the market. I think you're about a year old, technically. Started out with $1 billion in equity backing from Goldman, which we have to be sensitive about just because of the nature of financial agreements. But that makes you that day one battery storage unicorn, which I think is a really exciting prospect. But before we get further down the road, share a little bit about your background, how you wound up here, and I think that'll really help us frame the rest of the conversation.
Well, thanks again, John. And yes, you're right. We launched officially. I hired my first employee in June of 2022. So that's sort of when I start counting. I spent a couple months before that getting the entity set up, incorporating it, coming up with a name, but not doing much
the boring
actual business. Yeah. My background, I've been in the renewable energy business since 2002. I got involved first as a developer on the ground of wind projects up here in the Pacific Northwest for a little startup called Zilka Renewable Energy, which was acquired by Goldman Sachs actually in 2005 and became what's now, became Horizon Wind Energy, and is what people know now as EDPR, which is the Portuguese utility. Led development for the Western United States for them for almost 7 or 8 years before leaving to start another private equity-backed renewable energy company, this one called Element Power, actually backed by some former Goldman partners who left to start something called Hudson. We were a global wind and solar developer based here out of Portland for the North American division, and I was the chief development officer there. Later, when we exited that company, I moved on. I worked on my brief foray out of renewables. I was working on public-private partnerships and infrastructure projects for the 3 West Coast governors and treasurers. And then Google recruited me to go work there, did a number of different things, but spent 7 years at Google, principally focused on managing their fairly sizable book of investment in renewable energy. Google invested a few $1 billion in renewables after the last financial crisis to help prop up that business and to meet some of their goals. And then I worked for the data center energy team there, procuring energy from people just like myself on the other side of the table. So it's been an interesting sort of full circle ride through the three last booms of renewables. Now find myself in storage, which I think is really, cutting edge of interesting new stuff that's happening at scale. There's a lot of cutting edge new stuff happening, but this one's actually getting deployed in reasonable volumes today. And really excited to be here. And the brief story of GridStor is basically it's Goldman Sachs platform for battery storage deployment in North America. So we're very narrowly focused. We only do grid connected projects. We don't do hybrid projects connected to wind or solar. We don't do behind the meter. And our projects tend to be large, and they tend to be sited near loads in urban areas.
So it doesn't take a journalist's eye to identify that you are no stranger to the private equity backed developer or Goldman.
Yeah.
Why is it that lane has been so well established for you, and you decided to keep on that route with GridStor? Did Goldman come to you and say, like, we want you back in the fold for something new?
Yes, and the irony of that whole thing is before the renewable energy thing, I was not really headed on the path of being the CEO of anything, much less a large private equity-backed company. I was
What
a
do you
Peace
mean?
Corps volunteer. Well, my first job out of college was a Peace Corps volunteer. My advanced degrees in public policy, not business, and my second job was being a lobbyist for an environmental group, and then a regulator for an environmental agency.
You're a
So
true
I didn't
believer.
necessarily.
We don't get a lot of those. I always point it out because, like, every CEO in our space is like former Wall Street, worked at Lehman or worked somewhere else, around the crash, and then went in our world when tax incentives became super attractive. But I do love hearing kind of the environmental origins are they seem to be rare these days.
Yeah, I certainly don't know many others, but I'm proud of that. I mean, I am here because I believe in what I'm doing, and I basically got to the point in my career where I realized the way to have a bigger impact was to have more capital available to deploy into the things that I believe in. And I had a really positive experience when Goldman Sachs acquired Zilka and turned it in Horizon. They promised us two things. They said they were going to give us a lot of money and open a bunch of doors, and then would largely leave us alone. And they did both of those things, and we were hugely successful. So that left me with a very positive impression of the firm and also some of the individuals. And one of those individuals, Ken Ponarelli, was actually part of that transaction, and then reached out to me about this opportunity that is now GridStor. So yeah, been a 15-year relationship there, and they've treated me well.
As I mentioned, we can't go into too much detail around the raise from Goldman, the $1 billion close there, and starting off with that capital behind you has to be advantageous when you're entering a pretty competitive market that is still, by some accounts, early stages, but it's becoming more mature, and you're getting some clear leaders in the space, every year. But can you speak to maybe the broader context of raising money right now, launching new platforms? Like, what does the capital market look like while we know that the broader industry is facing these macroeconomic headwinds of inflation and interest rates? And you hear about private equity sitting on the sidelines while the Inflation Reduction Act is still sorting itself out, and tax equity has somewhat stalled, according to some asset owners. How would you characterize it, just given that you have somewhat recently gone through the process?
Yeah, no, I think I have a pretty front row seat to all those questions, to be honest. I would say that on the equity fundraising side, things continue to be very positive. I would say that, their expectations. So I guess if there are lots of private equity and other pools of capital seeking to invest at the equity level in platforms and in projects across North America, that is not abated. I think people's return expectations are higher because of what they can make just leaving it at the bank, right? So that obviously has an upward pressure on expectations. But I would say, and it's going to sound like I'm talking my own book, but you're in this space and I think you can validate that it's true. The broader market woes have not really manifested themselves in renewable energy over the last 18 months. It's one of the few pockets where people continue to deploy, even if their whole overall allocation of dollars goes down, the allocation of renewables is generally going up, not down, leaving them net, positive or where they were before in terms of the money coming into the space. I think that's, verified by a lot of third-party data. I think the question is, where is that money going? What risks are people willing to take and not take? I think there's generally people prior to some of the recent interest rate hikes and people throttling back a little bit in their aggressiveness on investing, people were starting to move much more downstream into sort of like pension funds directly owning a platform. You've seen that with Innov Energy and Pattern and many other firms where this has been repeated. The Canadians kind of paved the way, but I don't think it's just them. A sort of LP, what you think of as traditional LP investors that would invest in a fund, actually going directly and buying a platform. I suspect that's probably, you know, slowed down a little bit, but I think in equity level investments into quality platforms, we just saw the ConnectGen transaction with Repsol, Jupiter's transaction with BlackRock, specifically in the battery storage space. You see some, big major parties who are coming in with big checks and buying quality platforms. What I think isn't working is just, hey, I'm in this space that's shiny. I haven't really done anything particularly impressive, or I don't have a heck of a great differentiation story. That's not working quite as well, but the platforms that have something to offer, that have real depth in their portfolio and a good team, still seem to be a pretty attractive investment for people. That's at the equity level. Going to the tax equity piece you mentioned, I think that's really where the biggest challenge is. And everybody's been crying. I've been yelling this for several years when I was at Google. I'm actually proud to say I convinced them to go back into tax equity investing, not because they could make such great returns doing it. That was, believe it or not the most compelling part of it. It was that these projects just aren't going to get built without it. And if we just rely on the four big banks, they make no secret about what their capacity is. You can do the math. It's a fraction of what is needed. The supply and demand imbalance is really huge. And these transferable credits, which we're working on our first transaction using that mechanism right now. So I'm holding judgment until we've got it done and dusted, but it's not quite the simple transaction that it was. It's simpler than a ridiculously over-lawyered, over-structured tax equity partnership, which is among the world's least efficient transactions, but it's certainly not quick and easy. And I think part of that has to do with the treasury rules, and part of it is that the people who are used to doing these things thrive on complexity and in fact get paid for it.
You are not the first guest to shine the light on the inefficiency of tax equity financing.
I've been part of that inefficiency. I've put food on the table for my family through that inefficiency, but I'm still honest enough to admit what it is. It's inefficiency.
So I do want to get into transferability and even what you're working on right now. But so why has tax equity drawn back so much, if that's even the case? I just hear about developers dealing with banks that are already risk averse. It's a risk averse process to begin with, and they're still saying like there's too much uncertainty out there. That it seems like the consensus in the market, in the industry, is that is unlikely to change in the near term, next year, 18 months.
Yeah. So I think it depends a lot on what kind of deal you're doing, right? If you're doing a 20-year toll with a rated utility, yeah, that no one's going to tell you that that's too risky. It's just a question of how many hoops do you have to jump through. I think, full merchant exposure for tax equity, probably some very long conversations with those parties. My sense is not that they pulled back. My sense is that the market has vastly expanded because there's all these new asset categories, including the one I'm in. What we're doing wouldn't have been eligible for credits until the IRA passed. The same thing for hydrogen and all the other new categories, electric vehicle charging. There's just so many new kinds of credits being added, and no attention is paid to who is actually interested in acquiring those tax credits, and is there any supply and demand imbalance? And right now, that just doesn't exist. In the process, having got a corporate that had already done it before to the tune of a couple billion, but sat out for several years, to get them back in, it's a very large process. The number of people you have to get on board in a large corporation, tax, treasury, legal, FP&A, the business unit that's going to sponsor it, PR, like there's the CFO. You got to get a ton of people involved to go do a big transaction like this. And most companies, that's nobody's day job to go do all that. That's why it doesn't happen.
So you touched on a couple of points there, how the Inflation Reduction Act has really shifted the business model and opened up the market to energy storage so that it could gain access to the investment tax credit without having to be paired to a wind or solar farm. Can you kind of walk us through how the landscape has changed post IRA and how you're able to scale a standalone grid scale storage company? And then maybe we'll work our way to transferability, but sort of what's the What's the business case for what you're doing?
Yeah. So obviously the storage, I mean, one of the reasons I'm so interested in storage is there's really two reasons. One is it's so new in terms of what this technology can do and how we're going to deploy it, and what the tools that we're going to use in terms of how we're going to structure offtake, how we're going to finance these things to really maximize the benefits that storage can provide. Because in my opinion, we've just scratched the surface. Like the, the, the variety of things that batteries can do is so much more complicated than wind turbines or solar panels, that I just don't think we've really gotten to the bottom of all the things that we can do and all the new commercial structures that'll evolve around that. And I think that's super exciting. And we've got some ideas, but other people are going to bring new ideas that I have never even thought of. And I think that'll be what's interesting. And so I think my point of my comment is that what we've seen so far in the market are really sort of one or two uh, flavors, if you will, and I think there will be many more. The flavors that you hear about the most are either a full toll, which is basically leasing your battery to the utility or someone else to say, you tell me how to use it, and you get paid a fixed amount of money with
Kind of like a
some variable
traditional
O&M.
PPA for wind and solar, right? Isn't it? It's a little
Yeah.
easier for the utility to understand.
Yes, and those, like a traditional solar project, are going to be bid down to a cost to capital basis because it's a pretty low risk endeavor, right? You know you've got a customer, it's a long-term contract. That should be quite easy to finance. You should be able to get a high amount of debt at low rates for that, and a tax equity investor would probably like that. That's a very small slice of the market. That's like in regulated markets where they file an IRP and the PUC says, okay, you should do a battery, and really they probably want to own it. You're competing against the utility self-build ownership thing, and you've got to be cheaper than them. And so there's that whole business. We have not spent a huge amount of time in that, but that's going to be a significant part of the business. The other sort of bookend, the other extreme, is Texas pure merchant, where most batteries in this country are in really two states. It's overwhelmingly in California and Texas. And it's interesting because the incentive and market design is totally different. In Texas, you have no certainty about anything. The government's not promising you anything. The utility's not promising you anything. They're not even promising you if you can deliver your power or how much you're going to get paid or if you might even get dispatched. But they use pricing signals. When the price gets very high, you get paid a multiple of what you would get paid under normal times, and that's so-called merchant revenue. If you can get comfortable with your forecasts, is something that can be quite profitable, and something that banks have lent money against. But it's an emerging, what they're willing to do and under what circumstances and what do you have to bundle that with, is all sort of an evolving story. And then in between is mostly what we've done, which the California market I describe as kind of the three bears kind of right in the middle solution, because you've got an RA contract, or resource adequacy, which is kind of like a toll, but it's only on a portion of the output, and that gives you a long-term, in our case, 17-year contract with SoCal Edison for our Goleta project. We know we're going to get X amount of dollars per kilowatt month under that contract. And then on top of that, we can go out and do other kinds of transactions in the market and take our view of what that's worth. And in California, there's a daily shape. Everyone knows about the duck curve. It's a little less
we don't
crazy
say that phrase on this podcast. I'll bleep that.
Oh, sorry.
No, I'm just kidding.
There's it's more of a predictable, every day there's a pattern almost every day that you don't make crazy amounts of money. It's not that wild of swings, but it's a very predictable swing. And what we're doing is integrating solar into the grid in California, which is a very valuable thing. And that's basically the three broad brushstrokes, sort of ways you can make money right now, today, in this business, in my opinion.
And one of the biggest differences, as we discussed with Jeff Bishop from Key Capture, is that merchant allows you to optimize your battery based on your software stack and market conditions and wholesale market participation, whereas a tolling agreement, you're simply at the whim of that offtake and supplier in that scenario, which is the utility, right? Is that the way to best characterize it?
Yes.
We have this asset that, as you mentioned, can do so many things and is very versatile, but the way we see it through the lens of a tolling agreement is quite rudimentary. And maybe part of the reason that we still struggle at the regulatory level, understanding what a battery is. Is it load? Is it a generator? Which bucket do we put in, and all of that kind of stuff?
Yeah, I mean, I think you're on to two really important points, which is a battery is really hard to dump. The number of things a battery could qualify under sort of traditional utility regulatory practices, all the things you mentioned, and then ancillary services too, which,
Yeah.
to be honest, as a wind and solar guy, I've been in this business for quite some time. I was vaguely aware of the term ancillary services. I could give you a hand wavy answer to what that was after 2 decades in this business. And now it's a huge part of what we think about all day, every day. And for those who haven't had the pleasure, that's part of quote unquote keeping the lights on. You have to have the voltage and the frequency of the line. So if it's 138,000 volt high voltage power line, it needs to be 138, not 145, not 132. Batteries are very well suited to making those adjustments in real time, milliseconds. And no other renewables technology can do that. That's historically all been fossil-based stuff that could do that. And then also the frequency, so keeping it at 60 hertz is something that batteries are really good at. So yeah, how do you really stack up all those value streams from batteries across time and in the moment? How do you optimize them? These are the things that are going to keep us busy, not just for the next year or two, but I think for the next several years, figuring out better and better ways to do this.
Well, and ancillary services in Texas has been the primary role of batteries within the
Yeah.
ERCOT region, and starting to hear that even that segment is getting a bit saturated and going to require a little bit more creativity from our developers and asset owners. And part of me wonders how all of that shifting market landscape in Texas contributed to Jupiter Power and the Blackstone deal. And they just have such a intimate focus on ERCOT. So that's maybe just me rambling and pulling things out.
No,
of the air,
I think I have had the same thought myself. So yes, you're absolutely right that ERCOT was heavily focused on ancillaries for the early movers and where the majority of revenue came for many of those projects. We are sort of a early mover, but not a first mover. I think of Key Capture and Jupiter and a few of the others as the first mover, broad reach. And they really went big into that market. We could tell by the time we were starting to think about deploying capital, that writing was already on the wall if you were looking for it. It's maybe a little less broadly accepted than it is now, but we saw that and we factored that into our siting decisions. So we've assumed a declining ancillary, as I'm sure all those players did too. They were just
sure.
early. But for people like us who are coming in a couple years later, I think you have to bake that into your business plan and have an idea of where that revenue is going to come from somewhere else. And Andy Bowman is a long time old friend and someone who's been successful not once, not twice. It's his third time. All heavily Texas based. So I think that starts to create a pattern that you think Andy Bowman understands Texas quite well. So kudos to him for being successful. But yes, I think that their move to other markets, coincident with their new investor, makes a lot of sense, because at the end of the day, a company like his or mine, you will ultimately be seeking to bring in a new investor who's got a lower cost of capital than you do, which tends to mean lower tolerance for risk, all else being equal.
And so, I hope I'm not.
I
hope I'm not getting confused on the Jupiter and the broad reach power deals, because those did happen somewhat close together, right? So Jupiter, I thought, was the Blackstone deal, but correct me if I'm wrong. And then didn't Broadreach Power
just
BlackRock?
It was
BlackRock. Excuse me.
Blackstone is the investor in IPA. So IPA, which is another one of our competitors.
Blackstone's our parent company, so I need to get this right. I think, or it might be BlackRock. I'm gonna have to put a double disclaimer.
Okay.
Yeah, I'm gonna have to put that at the end of the episode. We are supported at the very highest level, by either Blackstone or BlackRock. You can reach out to us with any complaints.
I'm not here representing either of them, so
no, I know you're not. But so there were the Broadreach Power deals, and then because Broadreach Power just offloaded a ton of assets to
NG
infra fund. Okay,
it was NG, right, which is a operator. Yeah, they're more of a strategic. Yeah. So there've been a lot of transactions lately, and I think what that shows is there's real interest in batteries, but for different reasons. So Shell owns Savion, which has a significant battery portfolio. I think they plan to use those as part of their actual power trading, because that's a big thing that Shell does. And I think in the case of of BlackRock, they're saying this is part of that's part of a fund that they run. So I think companies are getting in with slightly different strategies, but there is a lot of capital that wants to come into this space. Both because it's going to grow, I think, proportionally. You can't just keep adding more intermittent renewables without adding storage. So I think if you believe the growth trajectory of wind and solar, which I do, then it's not too hard to believe the growth trajectory of storage.
Blackstone acquired Clarion Events, our parent company, in 2017. So I did just
okay,
confirm
there you go.
it's Blackstone. It's not BlackRock. I hope they're listening to this and see me as a model downstream employee. Okay, that's interesting. And just to round out kind of the market discussion, so we talked about resource adequacy, which is basically a capacity agreement. We talked about merchant markets where you're optimizing the battery to play off price signals and participate in wholesale markets. And then we have the newest program emerging out of New York, the indexed energy storage credit or whatever it's called, which is a little bit, piece of each of those, to my understanding, and seems to be something that some in the market like. Jeff Bishop from Key Capture supports that mechanism. Others do not. Do you have a take there? I know this wasn't in our outline, but curious.
No, it's fine. It's a fair question. So I would first say that I would tip my hat to my colleague Jeff, has spent a lot more time evaluating NISO policy than me. So he probably knows it better than I do. My team has spent time evaluating it, and our take was basically like many things we see coming out of New York. And most of us went to policy school or some kind of, we love these nerdy policy tools, but it's just sort of making something too complicated more than it needs to be. And we think it's going to end up being not as, New York has a long track record of incentive programs that are sort of several days late and $1.50 short. This feels to be a continuation of that. Like, it's the thinking behind it, yes, is well intentioned and thoughtful, but there's not enough confidence that it's going to provide sufficient revenue to underwrite an investment thesis. And so for us today, not a place we're actively pursuing. We think New York has tons of fundamentals that should make it a great market at some point, but people have been saying that. I mean, Key Capture's been there for many years and still are, I would say still waiting. And that's, I think, the broad industry perception, with a few. Also, the NIMBY challenges in New York have become, pretty significant, to the point where it's probably worse than California in many places.
It's interesting you point that out.
And at least in California, the sort of commercial thesis is there. It's challenging, but the idea that you're going to get paid and that market's not going to go away is much stronger there.
Well, and that opposition is getting a bit more fuel by the governor, launching the task force to examine and investigate battery fires, which I think we all admit within the space is an important focus, that safety and reliability cannot be ignored. But on the whole, we're talking about 1%, maybe 2% of batteries experience a thermal event like that. New York has unfortunately experienced, I think, 3
they've borne the brunt
summer.
of it. Yeah.
So, I mean, it's tough.
It's something we as an industry, look, I've been through this with wind. I was on the early days of wind and all the NIMBY concerns that were associated with wind, and the non-NIMBY concerns like bird death. Like, some of them are legit. This is a question. Fire is a legitimate issue that people deserve to have quantifiable, reliable, data-driven scientific answers to. Full stop. Like, no caveats. The public deserves that, and we need to provide it. I think if we could get our act together to provide this information in a comprehensive way, and also risk analysis is something most Americans struggle to understand. Like, when we're we just have seen examples like in Texas, where oil and gas based communities are worried about the explosion and fire risk of a lithium battery that's sitting on top of like a giant oil pipeline. Like, well, the oil pipeline,
like, methane flaring
has a proven. Remember that time in when PGE's poorly maintained gas pipeline blew up in suburban, a whole neighborhood. Remember, the Deepwater Horizon? Do you remember, some of us old people, the Exxon Valdez? I mean, we're aware how many oil tankers have derailed and blown up and caught fire and spilled. Like, these things happen every day, and we're just immune to them. And, that doesn't mean that we get a free pass in the battery industry, but we need to remind people that, relatively speaking to all of the other alternatives, these are in fact quite safe, and we need to do a much better job of communicating.
But for all that to keep you out of New York, at least for now, is significant, because New York has some very lofty goals as it pertains to energy storage deployment. They, through NYSERDA, are procuring a lot of storage. So as it goes,
yes. How much of it's getting built, though?
Well, yeah. I mean, great point, because those two things are different. But at least there's the outward desire to obtain more storage.
Your point is well taken.
Yeah,
Your point is
but
well
there's only a
taken.
handful of states where that's the case. Honestly, I mean, you mentioned California and Texas, and then it's New York and
And then what?
Massachusetts, and yeah, and then there's the then what category, which is probably Mass, probably New York. I think Illinois, just given how much they've pushed into DG, probably want a lot of storage too. But those markets are nothing compared to Texas and California. So
Correct.
um,
And now there will be a big market, I think, in WEC. I mean, you've seen a lot of large, just here, my hometown of Portland, Portland General Electric contracted, I think, two 200 megawatt projects,
yeah,
both 4 hour from Eolian and Nextera. That was their first foray into storage. That's a pretty big foray. So I think you'll see more and more of that in the IRPs in the West, with all of these transitions to zero carbon necessary in the West, that they're going to have to do it. Whether those will create interesting business opportunities for third parties such as ourselves, I don't know, but there will be significant deployments in the WEC. And how much of that the utilities will get to own and how much of that will have to be competitively bid remains to be seen. The other piece that we haven't talked about yet that I think is also, among the buckets of things that haven't been done yet, but clearly need to happen and hopefully will get done, are what about all these, the thousands of companies at this point that have committed themselves to addressing their scope 1, 2, and 3 emissions and to, becoming carbon neutral with their
that's a
emissions. And
2050 problem, Chris. They get to
well,
make
there
those
are
commitments. Yeah, I
companies.
know.
Some of those companies have actually committed to interim goals that are relevant and more aggressive, and especially the ones that really want to be market leaders. They're now saying, it's not good enough to match our annual um, emissions on a global basis with clean energy purchases. We need to match those in region or within time or both. So really, the only way you get to that, storage isn't going to solve that whole problem, but it's one of the tools that it's pretty hard to imagine how you get to those kind of outcomes of, 100, zero, as Microsoft calls it, or 24/7 as Google calls it, without the deployment of storage at significant scale to time shift when the incidence of those renewables, right? So if you're buying wind in SPP, it's blowing at one time. That's not when your load is kind of all the time. Same thing if you're reliant on solar in the desert Southwest, you need a way to shift that. So I think I think all of those entities are figuring out how storage fits into their overall plans and how they can, because there's also an economic argument for it, right? I mean, if you're buying a lot of wind or solar in these sort of resource ghettos, as I call them, where there's no load and just a lot of gen, your marginal price is getting killed because everybody else is generating at the same time. Storage can help you prop up the value of that resource while at the same time increasing value. I mean, economically, how much you get paid, but it could also make it more valuable to the customer by delivering it at the time that they need it. So I think there's a bunch of different ways that storage will get, there's new types of storage contracts that we haven't seen yet that'll come on. And um, I think we're just starting to scratch the surface of what else we can do here.
And we talked a lot about hourly matching and additionality and the locational value of clean energy in our last podcast episode with Andy Marsh, the CEO of Plug Power, over this debate about green hydrogen incentives. And, previously had Jesse Jenkins from Princeton on the show, which he takes a very opposing view to that of Andy Marsh and the green hydrogen industry itself. But yeah, it's very,
Jesse thinks you have to do it match by hour in
yeah,
region, right?
hourly
Yeah.
matching in region, deliverability, all of that, or you're risking spending hundreds of billions of dollars on incentives for pretty dirty hydrogen. That's Jesse's feeling. Andy
Yeah.
Marsh's feeling, just to summarize, go back last week. I thought it was a good episode, regardless of where you fall on the debate. I think it's important to at least hear the arguments. But he essentially says that starting out with hourly matching versus annual and requiring in region power purchase agreements with solar and wind that are close to the hydrogen production would squash the industry from the get go. So maybe there's somewhere in the middle that where reality
Yeah.
exists. I'm not entirely sure, but just sort of back to GridStor, you mentioned a little bit about your value proposition and your market focus, but let's dive into that a little bit more. Which regions are
Sure.
you most interested in, and which market mechanisms are you participating in, whether merchant or
Yeah.
contracted? Are you doing any DG? Are you only focusing on transmission?
Yeah, so we're currently not doing any although we have projects in California that are under what they call the WDAT, which is a California specific process for anything below sort of sub transmission, like 69 kV, what would be on the fence somewhere else. So we're in both the CAISO process with the Q cluster study, which everyone's familiar with, and this WDAT process. We're very heavily focused in Southern Cal Edison territory at the moment. To be honest, it's just a place that has a lot of strong fundamentals. Like I don't think load growth is going to go down there anytime soon. I think building massive new transmission lines into Los Angeles anytime soon is going to be very difficult.
Or
They
anywhere.
are actually, yeah, but especially there.
It took Pattern a decade to do it in New Mexico. What do you think is going to happen in
Right.
Southern California?
Try it in LA where every third house is a lawyer.
Right.
I mean, it's going to be hard.
That's funny.
So I think that is durable. And more importantly, kudos to California. They're actually shutting down the coastal fossil. They're not just talking about it, they are doing it, albeit more slowly than maybe some people would like, but they are actually walking the talk. They are turning down fossil, they are increasing renewables. And the way to keep the lights on is to add storage. So we think the California market has a long track record. I've been making bets on the durability of California energy policy for 2 decades, and so far it's worked out pretty well for me. I think they're not going to suddenly have an election and vote in a Trumper and abandon their views on climate change. Like that's just not going to happen.
Be quite the heel turn.
Yeah, things will come and go and things will change, but I don't think you're at risk of those kind of extreme policy shifts there. Contrast that with Texas, which has had this incredibly, fascinating. I mean, I live in a blue state. Most of my friends are Democrats, and I love pointing out to them that, one of the most attractive markets for guys like me is Texas for a bunch of reasons that they're not going to like. The truth is, though, Texas has stopped being quite as balanced as they were. And I think that the beauty of Texas has been saying, hey, it's been truly a fair fight between all resources. And if you can provide value and be competitive, you're welcome here in Texas. Now it seems to be, if you don't screw up the planet in some way or the other, then you're not welcome here. And that it's, besides being just crazy, it's not great for our business. But I think Texas will remain an attractive environment because they are also even higher load growth than California. Houston load growth is off the chain. They will build new transmission faster than almost anywhere else in the country, but not everywhere and not all at once. So those are two markets that we see as, those are the two obvious ones that will clearly make up a sizable proportion of our portfolio. Personally, for GridStor, I'm of a view that having a blend of contracted and uncontracted assets is what's going to drive value in the long term, because when you invest the level of equity we're investing, you're ultimately going to be looking for another round of investment in a pretty large check size. And I don't think those are people who are going to want to put all of that money in purely merchant exposed deals. I think merchant is where you get a lot of upside. You can earn superior returns. The story is pretty clear, but you also need some contracted assets in there, whether that's through resource adequacy, tolling, or some kind of a C&I offtake structure. But I think that's sort of the three-legged stool that we're searching for.
You may not have any thoughts on this, but we did have this story in our episode of This Week in Clean Tech 2 weeks ago on ERCOT considering new rules for battery storage in the market that is being met with quite a bit of opposition from the industry. I don't know all of the details, but I remember one of the things jumping out to me was some 2-hour reserve power requirement for all operating assets and just some really strange frameworks that don't necessarily reflect what battery storage is best at. Do you have any thoughts there, or have you guys been watching the developments in ERCOT and how that might shift things?
We have been watching, and I think there's a couple things going on. The shift towards 2-hour systems, we kind of saw that coming and have been anticipating and doing our modeling around any projects we build in ERCOT would be 2-hour systems. But I think you might be referring specifically to the requirement that you have a full 2-hour state of charge to be able to participate in their, it's their RRC market. And that part, the initial read from the industry is that that's overly restrictive and probably not in anyone's interest, in the sense that it's not great for us as businesses, but also just sort of arbitrarily takes out a lot of available resources that could help solve the grid's problems. contrast that with just here in September, Texas had their largest September load event ever in the history of the grid, and batteries kind of helped save the day. And
Yeah.
ERCOT acknowledged
Well,
that.
it's almost every
So
day
I
they're
don't know.
setting these load records. It's not even like a
Yeah.
one-off thing.
I mean, we're getting beat up. We, the storage industry, are getting beat up politically because the way I describe it, I hope I'm not offending anybody, is we're sort of renewables adjacent. We're not even like, my company doesn't build wind or solar. I believe in those things, and I used to do both of those things, but we're just a battery company. And somehow that is like one step removed from clean energy, which is something that's not super popular in some quarters in Texas right now. But I think cooler heads will prevail because there just aren't, building a bunch of new publicly subsidized fossil fuel polluting plants today is not just terrible public policy, but it's going to take a while. We can build these batteries in 6 to 9 months, and that will happen. It's going to happen. And I think we'll be able to solve a lot of these problems and hopefully prove to the public that storage should be part of the solution too.
Just for the sake of time, I want to wrap up on kind of corporate buyer sentiment and what you've brought from your experience at Google, being that buyer and facilitator of clean energy and storage and all the other things. But if we can round out the market fit conversation with that transferability piece, how critical is that to what GridStor is doing? And can you maybe explain a little bit how that differs from that traditional ITC model under the legislation and what you think the potential is there?
Yeah. So in a traditional, I'll try to make it as succinct as this isn't a very overly complicated subject that I'll try to summarize as succinctly as I can. So in a traditional tax equity investment, a third party comes in, a bank, an insurance company historically, and then lately some very large corporates, and they invest at the project level. And in return for that investment, they get a stream of most of the tax credits generated by the project and a little bit of cash. And then eventually there's some swapping that happens and the ownership flips back to the original equity owner, either through a buyout or just through time or other mechanisms. That's the simplest way I can describe a tax equity partnership. There's like 4 or 5 different flavors of yield-based flips and time-based flips and sale leasebacks and all that fun stuff. But that requires this third-party investor who's often sort of a passive entity that's not in the energy business, like an insurance company, to come in and get comfortable and underwrite all the details associated with a very niche-y, bespoke energy project. With this transferability, we, the person who owns that energy project, can go to a party that would like to reduce their tax payments next year and say, we'll sell you $1 worth of tax credits for 95 cents or 87 cents or whatever the number is. And then that's a pretty simple transaction. And the way it's written, the party who buys it has the risk of recapture. So we will have to indemnify them, meaning if we somehow stop running the project and they were to lose their tax credit, we would have to pay them back. That's that's about as simple as I can make it. I hope that was simple.
No, that helps. So then is the transferability process make this more efficient for you? Or, I mean, I guess it's still a learning experience because you're doing your first one, but just kind of.
So here's my take. I mean, the thesis was that you don't have to truly get your head in and understand, because we're not getting any cash, right? We're not stepping into the cash flows of the project. We're not truly an investor in the project. We are buying the credits. It should be a lot easier. My cynical answer to a lot of my colleagues and friends, who I like very much, but there's a whole industry that's propped up around this of tax advisors, lawyers, accountants who have done very well by overcomplicating this, and they don't have much incentive to make this new thing, which was supposed to be simple, because complicated has done very well for them. I don't know that it's that cynical or if it's just people are conditioned to make things overly complicated, but I would say we have not realized the full promise of the efficiency of the tax credit transfer. And hopefully over time, we can drive those costs down. And there's people trying to create these online platforms for buyers and sellers to just, transact. It should be frictionless. How many cents per dollar are you willing to pay me? Boom, let's settle on it and be done with it. We're not there yet, but give it a couple cycles and hopefully people will figure that out.
If you want a really, really good rebuke of the tax equity structure for deploying clean energy assets, go to our episode with Tim Haid, the co-founder of Scale Microgrids. Skip to like minute 40, and he really ramps up his criticism of this is kind of insane that this is how we do things and this is how inefficient it is. But wait, we don't need to go completely down that road. Just to round it out, Chris, with your experience at Google, kind of playing on both sides of the fence, being a developer asset owner and also being on the, corporate procurement side and handling a lot of those contracts. You mentioned Google and Microsoft have these 24/7 clean energy goals that go beyond annual matching to say we're 100% renewable energy and really get into the teeth of what's making an impact. And as we know from a number of reports, I think the evidence is pretty clear. The 24/7 approach is what can truly make a dent into our climate problem, whereas annual matching with power purchase agreements or virtual power purchase agreements do not necessarily move the needle as much as we had hoped, or maybe people knew that from the beginning, but I think that's just the evidence is becoming more clear. What would you say about broader corporate sentiment towards storage and maybe how it's changed in the last couple of years as this has become more well understood? Is the 24/7 thing going to make a real impact for businesses like yours?
I certainly think it will, whether that will be through direct transactions with those end users that are pursuing those goals, or whether it'll be through the, at the end of the day, I can speak, I think, for Google, because I used to work there. They don't want to be an energy company. They want to be a data center, and technology company, but their host utilities are not doing the job. They're not hitting the targets at the pace that Google believes is necessary to avoid planetary collapse. So they're going out and doing these transactions to accelerate things. But I think all of these tech companies would tell you what they really want is an affordable, reliable, clean source of energy from their host utility. And all of this is directed at making up for the shortcomings of those. If the grid would just move, all of these initiatives are designed to move the grid towards a greener solution faster, and that's where we really should be focusing. And that's why all these corporates are doing it. So I think it'll lead to more business for guys like us, whether we're doing deals with the utilities or with the end users or both. And we're happy to do both. We just want to be part of the solution. But yes, I think that push is really what is driving this. And I think it's running into some brick walls in parts of the world that have not reformed their utility regulatory structures, like in Asia. They don't have a lot of choices. Like they can't do bilateral contracts. There's not a lot of land. Like it's not super easy to solve the data center problem in, say, Singapore or Taiwan, or frankly, in the southeastern United States where they don't have a lot of tools. So those are some of the tough to crack places that people need to keep focusing on.
Let's wrap up here. You've had a big year. You've hired a lot of great people. Go to the GridStor team page on their website, and you'll see the names that are familiar to many of us. Like I mentioned, the $1 billion backing from Goldman is huge. You're growing the portfolio step by step. What has been the hardest part about scaling this company and starting over with a new effort? What still keeps you up at night? What scares you a little bit? I like to drill down into those aspects because I think that's where the media stuff comes out.
Sure.
Maybe I should lead with that instead of always doing it at the end. But what's on your mind?
No, I can't. I mean, I think we have built a truly world-class team, and that makes me sleep a lot better at night now that we've gotten there. But I've never been in the business of trading power and merchant exposure, day-to-day prices. I've always been in long-term fixed price contracts as a wind and solar person. So we've hired some very smart people around that. But when you ask me personally, that's not something. So getting up every morning and reviewing our strategy and seeing how it did and how we can make it better. That'll be very interesting. I'm excited about it, but I got a little bit of trepidation because it's new. And then I just think the getting the supply chain domestic by 2026 is our goal. There's just, I know how hard it is to build projects in the real world because that's what we do. And having a domestic supply chain requires building a lot of real projects in America, which is hard. It's for a great goal, but we can't be sitting here in 2028 still arguing about where this stuff is coming from and is it creating jobs in America. I fundamentally believe that's our obligation. It's the right thing to do, both financially, morally, and planetarily. So I think that those are the things that I spend the most time thinking about.
Chris Taylor, CEO of GridStor. Thanks so much for taking the time to do this. This was fun.
Great to meet you, John. Thank you so much.
Thanks again to Chris Taylor for joining the podcast. Factor This is a production of Renewable Energy World and Clarion Energy. Join us every Monday as we break down solar's biggest stories with industry leaders who actually move the needle. And please leave us a rating and review wherever you get your podcasts. Thanks for listening, and we'll see you next time on Factor This from Renewable Energy World.